Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And over the break and a little bit before it, I spent my time writing another book. The title is Wealth by Design, and I'm going to tell you how you can pre-order that over the coming weeks. So I just wanted to mention it, throw it out there, and I'll be sharing more information. But let's get into today's Q&A episode. So the first question is from Emma, just to give you a bit of a rundown, mid-30s, she earns 190, husband 90,000, 200,000 in super balance. And the goal, they'll start a family soon, so no kids yet. And the goal is to reduce working hours after 45, so in 10 years' time, and retire before 55, so 20 years' time. They've got a home worth 1.35 with net debt, $1 million of debt, 450 in the offset, so net debt of 550. And 2 investment properties, studio-style apartment worth 510 with 270 of debt, and then a terrace house worth about $1 million with 450 of debt. And that's, I won't say the locations because Emma's asked me to keep them confidential. An investment bond in her name, valued at 110,000. It's in Vanguard High Growth Portfolio. Had that for 4 years, and some shares and ETFs about 15,000. Okay, so Emma's questions are: is it worth keeping the investment bond given it produces no cash flow and the main tax benefits occur only after 10 years? Or would it make more sense to withdraw now, acknowledging tax implications, and reinvest in property and or shares? I've spoken about investment bonds previously. The main attraction from a taxation perspective, and I'll answer this question for Emma, but just for those that are listening to get a bit of a broader sort of perspective on this, the big kind of carrot, if you like, that's dangled in front of people is that if you keep the investment bond for 10 years, you can withdraw that money and pay no capital gains tax. In fact, the income during the ownership period of that first 10 years is taxed inside a corporate environment. So you pay 30% tax on the income. And then when you realize the investment, whatever capital gains disappear. And that's the kind of attraction. Now that's fantastic, right? That on the face of it, it sounds like a good deal. The big question is, are you going to invest for 10 years and then turn around and sell that entire investment in one financial year? And that's the missing question when people are contemplating investment bonds. Because if you are, then an investment, and you're in the highest marginal tax rate or you're a higher income earner, then an investment bond is a great idea because there are some really good tax benefits. However, if that's not the plan, and it typically isn't, right? Typically, it's about building a portfolio of relatively liquid assets, not relatively, liquid assets, so shares, ETFs, so forth, and then enjoying the income that that portfolio generates and being able to potentially sell down some, but probably not all. In that situation, we don't really need to prioritize minimizing CGT across the whole portfolio because in Emma's situation, for example, when she's working part-time after 45 or not working at all after 55, she can gradually sell down that portfolio and she's probably not going to pay too much in capital gains tax anyway. So all you're doing by using an investment bond is you're adding another layer of fees and you're locking yourself in to making these sorts of investments and holding the investments in that ownership structure for 10 years, which may or may not suit you. Having said all that, Emma's in there now. She's 40% of the way, she's had it for 4 years, I should say. So she's got to hold it another 6 years. And the question is, what does she do? The answer would be, what are the unrealized capital gains? So it's worth 111,000. What is the cost base of those assets? And how much CGT would you pay? If for whatever reason, maybe because of timing or whatever, if the CGT isn't that material, then you probably say, look, let's clean it up and exit that and adopt a better strategy and avoid those fees. If the unrealized gains, I should say, are significant, then you just keep the bond. And quite often when we meet clients, that's our answer. It's just, let's keep it for the 10-year period. After 10 years, we're going to take it out and we're going to do something better with it. But you're in there now. You may as well enjoy the nil CGT benefits moving forward. But it all sort of ties back to what is the plan, because if the plan is in 10 years' time to sell a significant proportion of that portfolio or all of it, then maybe keeping the investment bonds a good idea. Okay, Emma's next question is, we're considering buying another investment property with a budget around 650, but the current market makes it difficult to find one that does not significantly impact our cash flow. Given our current situation and goals, would you recommend buying another property or investing our available funds elsewhere? This is an interesting question because, if you go back to 2017, for instance, you would have been able to find something for 650 that had a relatively high rental yield. Of course, what's happened since then is that the median house price has doubled in Brisbane, and as a result of the capital value rising so substantially, the yield is compressed. So the yields have come down, growth has come up. That's a normal sort of process. If we go through another flat cycle, yields will appreciate again relative to capital values. So the reason I made that observation is, as investors, we need to understand what worked then doesn't necessarily work now. So what investment decisions we made in 2017, 18, 19, for instance, in Brisbane, it's a different stage in the market. So you've either got to go, we're going to a different geographical market that offers us similar value-based opportunities that the Brisbane market used to offer back in 2017, 18, or you don't do property. I think 650 as a budget in Brisbane, you're going to make too many compromises in terms of the quality of those assets. So that's the first. So the answer would be, well, if you're going to add property, it's probably not Brisbane. If you're going to add property, it's probably a 2-bedroom apartment, older style apartment somewhere in Melbourne, still in a blue chip suburb, but 650 will probably get you something okay in that market. Investable, let's call it investment grade if you like. But I'm not sure adding another property is the right way to go, because you said you would like the ability to reduce working hours at 45, and you said your mid-30s. So 10 years' time, it's not a long enough time horizon if you're going to add more debt. Having said that, I acknowledge the amount of investment debt you have at the moment isn't that huge, right? But still, more debt equals more negative cash flow, gets you further away from the goal, not closer to it. So having a look at your properties, and I haven't delved into it, and this is not advice, it's never advice, it's only information, of course. But the apartment looks to be in a pretty good location. The terrace house looks to be in a sort of okay-ish location, but the type of dwelling, it's relatively new, it looks from the pictures. So, you're probably, okay. And I just looked up the apartment too. Both those assets don't really get me very excited. Like if I own both those properties, okay. But, you've enjoyed good growth probably because just in a rising tide, all ships rise. So I think if I was in your situation, I'd be thinking really critically about the $1.5 million you've got invested in property at the moment. And I'd be asking myself, is that the best that I can do with my equity and cash flow? Otherwise, what you might be better off doing is reinvesting that $1.5 million, maybe in one property, or maybe extending a little bit further and going to say 2 and buying something that has a higher quality. Now, whether that's in Brisbane or somewhere else, I'll leave that alone as a consideration, but that's really the key to making your strategy work. Is that if I explain it, what you want to do is early retirement. The challenge with early retirement is that you've got a longer period of time to fund in terms of retirement period to fund. And so therefore, what you really do need is a really good compounding capital growth engine to really make sure that even if you go down to part-time work and you're just covering living expenses, that your assets are compounding behind the scenes. So when you start drawing on that capital and income at 55, even if you live to 100 or beyond, you're still mathematically going to have that perpetual portfolio. So really that's the key success factor here, I think, is the best question you can ask is, what property decisions should you make today so that by the time you're 55, you're going to look back and go, wow, these really shot the lights out. And this is why I'm in such a great financial position today. And I've got the ability to stop working at 55. That's the number one question you can ask yourself, Emma. The last 2 questions Emma asked, which I've pretty much answered, would it be sensible to sell one of our existing investment properties to free up capital for other investments? And question 4 was, do you have any other recommendations or adjustments we should consider given our goals and time frame? I reckon I've answered those two questions, Emma, and really this is the window of opportunity before you start a family, because your borrowing capacity is going to reduce once you do that, and your borrowing capacity will probably be compressed for, a few years as I don't know how many kids you're going to have, but as you sort of build that family and, income's lower, expenses are unusually high for that period of time. So you've got this window of opportunity now to sort out the investments that you have and make sure that they're working as hard as possible for you over the next 20 years. So don't worry about what might happen over the next 5 or 10 years. It's really the next 20 years. Anyway, long-winded answer, but hopefully that helps you and anyone in a similar position to you, Emma. Okay, next question is from Maximus. I'll read it out because there's a bit in there. Sometimes I feel the bar is pretty high as the talk is usually in multi-millions of dollars and would appreciate your feedback as an average couple grinding to the finish line. We've attempted to leverage over the last decade and are ready to shift into a more of a cash flow positive scenario to allow some basic travel and social engagements and balance our lives a little better. So you're right, Maximus. I imagine that's a pseudonym, but we answered the questions, but that's really, that's our wheelhouse, I guess, is most of the clients we're dealing with have, by definition, a lot of investable funds, and that's what sort of, qualifies them or makes it worthwhile for them to pay us a fee to look after their scenario. So but hopefully, the same rules apply, right? The same approach. That's why I wrote Investopoly, and I've written a new book, Wealth by Design, because the same concepts apply whether you have $100 million or $100,000. So hopefully we have more varied questions. I mean, actually not hopefully. I don't mind if the questions are varied in terms of the numbers we're talking about, but the approach is going to remain the same. Anyway, let's get back to Maximus's scenario. Okay, we just ticked over 1 million net worth at age 42. Married, second time round, first was practice. Yeah, mine too. 3 dependents, 2 16-year-olds, must have had twins, and 1 1-year-old. He works full-time, earning 150 grand. Wife just going back to work casually, earning 50,000. Home is worth 890 with 367 owing. Investment property in Brisbane worth just over 700 with $500,000 of lending, and has a self-managed super fund bought a property in Blakeview, in Adelaide. It's worth 580 with 290 owing, and Maximus talks about, concerned about whether it's the right investment, buying towards the end of the cycle, even though the numbers stack up. It's interesting you make that, I can make the numbers stack up almost in any scenario. It's really about the assumptions. Anyway, I'll come back to that. They've got an offset account in the self-managed super fund, and that's where the contributions go, and they're building a little bit of shares, ETFs, DHHF, which is great, so that's fine. And Maximus goes on to say, they've had to sort of battle their way through life. They haven't had family to sort of educate themselves, growing up in kind of low socioeconomic neighborhoods and so forth. So, look, well done, Maximus, listening to the podcast, taking action, getting ahead, getting yourself into a great financial position, educating yourself about these things. It's fantastic. And, one of the main reasons I spend so much time on this podcast and answering questions on YouTube and so forth. Okay, so they're looking to move into a family property. They want to sell their home and use some of that money to renovate the dwelling on that property. The way I read this is that they don't need to buy it, they're just renovating it. They'll then move into their investment property to renovate that because it's obviously in need of repair, and then put a tenant in it again. And then use the equity in that investment property to debt recycle, so, borrow to invest in shares, and split their surplus cash flow between lifestyle improvement and dollar cost averaging in the share portfolio. Maximus's 5-year goal is to create a better work-life balance as our youngest is growing up in the country. The advantage is that we will have support from my wife's family as we'll be moving into the family rural acreage property. Keen to hear your thoughts on the shortcomings and strategy ideas. Well, the first thing I think about is security over your main residence. And I might have spoken about this before, but I have had a couple of clients where they've got some unusual ownership of the homes that they live in. And if you don't have direct ownership, it can create some uncertainties and reduce the ability to leverage these sorts of things. And remembering our home can sometimes be a great investment too. Maybe not if it's in a rural area, maybe not so much, but that's the first thing. So I would be thinking about, okay, what are the arrangements with the family? Can they grant you a life interest, which means that you've got the right to occupy occupy that dwelling whilst you're alive, and it gives you some certainty around these things. And the reason I say that is that, from an estate planning perspective, you can have a very well functioning family, and when the patriarch or matriarch, if there's an individual that really holds it all together, if they pass on and then the family needs to make financial decisions together, sometimes money can ruin that relationship. I shouldn't blame money. It's just human nature, perhaps, but that's the issue. So whilst everything's going well now, it's always good to put in place, formalities, particularly if you're going to sell your home, put money into the improvements on land that you don't necessarily have direct ownership. Now, I don't know the full details, and you might have that direct ownership, but that's certainly what I'd be thinking in terms of life interest with respect to that property. Give yourself some security. The self-managed super fund, look, you almost certainly have bought, towards the end of the cycle. Adelaide's been growing for about 8 years now. We know that since 1980, the data tells us that the average and median length of a growth cycle is 10 years. So maybe you got a couple more years. The other thing too, because of your price point and buying at the end of the cycle, have you made some compromises on that? So not only have you maybe bought at the end of the cycle, but then you've compromised on the quality. And whilst all the numbers stack up, I just don't know about it. So it's a pretty big decision to unwind what you've already done, because you've got some leverage at least in there. But I did a blog, I think last year or the year before it, that said that, I did an analysis, and the tax benefits around self-managed super funds and whatever, borrowing to invest in property in self-managed super fund are overstated, relative, because you don't get as much negative gearing in there. Although, that property might be, because of its nature, might not necessarily generate a lot of negative gearing. So I put a massive question mark over the superannuation strategy. You could do, because you've got a self-managed super fund now, is sell the property, get rid of it, clean it up. And instead of investing in DHHF, invest in GHHF, because GHHS has about 30 to 40% of gearing. So, your gearing rate with the property is around about sort of 50-55%. So it might be kind of similar-ish gearing, a little bit less GHHF, but still adding some gearing to super, but something that's going to, be a little bit easier to manage. Probably, you can course correct with GHHF. If you don't like the returns or whatever, you can sell and reinvest in somewhere else. Or if there's another geared investment that, that becomes available in the future, you can certainly add that to the portfolio. So I would think really carefully about whether it's a better move. And it's a good way to use a self-managed super fund, because you can pretty much do what you like. You need to have an investment strategy. It needs to be audited, all those sorts of things. But you've got a lot more flexibility with a self-managed super fund. And you're 42, right? So 18 years until you can access super. Adding that level of gearing, I think, isn't such a bad idea. So I would probably, again, this is not advice, it's information only. But as I talk through it, I think I'd be inclined to make that change and switch into GHHF. And then the final sort of thought was really around the Brisbane investment property, which you purchased in October 23. So you haven't had it for that long. I'm a little bit more optimistic about Brisbane over Adelaide, even though their growth cycles started at the same time. You've got the Olympics in Brisbane. I think that's going to drive, as I've said many times, more positive sentiment over the next couple of years. So I think that's okay. It's really just a question then of, what will the future returns be, forming a view on that, and what will the future returns be over the next 20 years? And if you're pretty happy with it, then you wouldn't change. You've got about $500,000 of debt against that property. So the question would be, if you're going to use more of your income for lifestyle benefits, I get that. That's cool. When you have more equity in that Brisbane investment property, maybe you could do some gearing as well. So, you're contributing some of your own cash flow into shares. Maybe you could use some gearing in addition to that. But I think that's the only things that sort of come to my mind, Maximus. It's really around security around home, life interest, perhaps making sure, forming a view on that Brisbane property. It's possible that you might go, well, I'm going to hold it to sort of 20, you might not hold it past 2032, but let's say I might hold it to 2031, take my money and invest it in a market that's more attractively priced, perhaps, depending if you were concerned about, whether the property had really strong attributes. And I'd probably take a different approach inside inside the super fund, because I think you've most likely bought an asset that is compromised in terms of quality, and at the end or towards the end of a growth cycle, I don't know, I don't have a crystal ball, but it just might mean the next 10 years of returns are going to be pretty ordinary. It's something I've seen, and certainly seen people that bought apartments, for example, 10 to 13 years ago in Melbourne, inside super really hasn't helped them in terms of build wealth. And that's the issue that I'm concerned with in your situation. But all the best. Okay, next question is from Maddie about using redraws. So Maddie suggests that she had an investment property and she used some of the redraw on that investment loan to go and buy a home. And she's saying because the redraw was used for a different purpose, it changes whether the interest is tax deductible. And that's why and she acknowledges I've spoken about redraw previously, that, you've got to be really careful around it, particularly if it's an investment loan. The way to fix this, right? So the reason, essentially, if you have, let's say, an $80,000 investment loan and it's got $20,000 redraw, so the total limit is $100,000. And let's say, and I'm going to use this as an example for Maddie, let's say that $80,000 loan, that's an investment loan, the interest is tax deductible. I then redraw the $20,000 and use it as a deposit to go and buy a home. So now the ATO would say that 80% of the interest charged in respect to that loan is tax deductible and 20% is non-tax deductible, because I've got a mixed purpose within that loan. If I then make a repayment of $10,000, the tax law, the ATO says that I've got to apportion the repayment also. And 80%, so $8,000, needs to go towards repaying the investment loan, which I never want to do really. And only $2,000 goes towards repaying the non-tax deductible portion, the home loan portion. So, which is not ideal, right? Because you want to be able to direct repayments to whichever. And also you don't want to have to, you shouldn't mix purposes within one loan. So the solution is that if I redraw that money, I've now got a $100,000 loan. As soon as I possibly can, I should refinance that loan and split it out. And so hopefully Maddie can still do that in her situation. So I would then go to the bank and say, okay, I've got this $100,000 loan. I want to split it into two accounts. Give me one loan for 80 and one loan for a separate loan for 20. And as long as I've got a clear audit trail of what that loan related to, I've got a clear audit trail. The original 80 was used for investment, and then the additional 20 was by redraw was used for personal purposes. As long as I've got that information, that documentation, I can prove it to the ATO if they come and knock on my door, then that's completely fine. So if you do use redraw, just make sure as soon as practically possible, split that loan out so you've got it into two separate loans. The second part of Maddie's question she's asking me is, what happens if I revalue a property, increase the mortgage, and then use those increased funds to repay a home loan, a non-tax deductible home loan? Does that work in terms of changing the debt? No, it doesn't. Remember, the only thing that is going to dictate whether a loan is tax deductible or not tax deductible is when you first made the acquisition. So whether you first bought the property, or whether you first redrew and bought another property, or whether you redrew and invested in shares, it is that point between drawing loan funds and buying an asset that will dictate whether a loan is tax deductible, and you have to live with that for the entire ownership period. If you go and increase a loan, an investment loan, for instance, and then by $200,000 and then take that $200,000 and repay your home loan, it adopts the purpose for which you've used those funds. So purpose is what's driving the deductibility, not the security, not the loan structure, not the applicants to the loan, any of that sort of stuff. It's the purpose. And so if I increase a loan for the purpose of repaying a non-tax deductible loan, it'll inherit that original purpose. And so that portion will become non-tax deductible. Over the years, that's been a common kind of misunderstanding around how loans work and so forth. And sometimes I've come across people that have done that, and I've had to say, no, that's not going to work. If the ATO comes knocking, they're not going to like that. So you just got to think very carefully then. When you buy an asset, typically what I would say is borrow as much as you can against that asset, because that's the only chance you get to crystallize the maximum debt, and then put the money in the offset account if you like. And then the second sort of rule is just be careful around using redraw with an investment loan. And if you do use redraw just because of circumstances, split that loan out as soon as you possibly can. Thanks for your question, Maddie. I hope that clarifies that for you and for anyone that's listening really around loans and loan structure. Okay, next question is from Matt. Thanks for your reply to the YouTube video the other day. I found your channel and it's honestly the best advice going around. Thanks, Matt. I appreciate it. I do aim to reply to, I hope this doesn't come back to bite me, but I do aim to reply to any comments on YouTube, and I do that personally as soon as I possibly can, usually within the same day or a couple of days. So it's easy to get me over there, and that doesn't mean I'm going to get 100 million messages tomorrow, but all good. Okay, so Matt's situation is him and his wife are 51. He's got three daughters, 23, 18, and 17, all still living at home. Wife earns 100,000. Matt stopped working. He's on long service leave until April, was earning $100,000 and would only like to work sort of casually 2-3 days a week. They own their own home, no mortgage, 750. They've got 5 investment properties worth just under 4 million with about $1 million of debt, so 3 million of equity there. They've got a self-managed super fund also with a property that doesn't have a lot of debt, only $80,000 of debt. The property's worth 710, 36 grand in ETFs. The question Matt has is, what's the best scenario for both of us to finish work by 55? So in sort of 4 years' time? That's a good question, Matt. I think the answer is you're going to have to sell a property because, I've spoken about this previously. Let's use round numbers. 4 million in property, 1 million in debt. So 3 million in equity before expenses or CGT. Let's just be really broad and say, let's make an allowance for $1 million for, it's not going to be $1 million, but let's go. Actually, there's about 2 million of unrealized gains. So that's about, let's say, $500,000 of tax to pay and some selling costs. So let's call it, what's that going to be? Sort of 2.324 of net equity after repaying all loans, tax, and so forth, which will fund you which needs to fund you certainly, obviously, between 55 and 60, but really for the rest of your working life. So, and then plus super, then it means you're getting close to sort of 3 million of investment assets. So I reckon you're on the right track. And essentially what you need to do is eventually get all that money into super, or at least most of it as much as you can. And you're not going to do that overnight, of course. It's probably going to take you, a couple of decades in order to do that, but that would be the broad strategy. The only way you're going to fund living expenses, I imagine your wife's going to stop as well. If you want to stop working at 55, you're going to have to sell some assets. So you'd have to work out which asset am I going to sell. And the consideration there, the main consideration is really future returns, future expected returns. So you'd sell the asset that has the lowest future expected returns. And that's going to increase your liquidity. You'd put some of that money in offset account and then maybe invest some. And then gradually, as you get closer to 60, move some of that money inside super. And so I imagine then it's gradually selling down that property portfolio over let's say the next 10 years to create more liquidity and get more into super. And you might end up deciding to keep 1 or 2 properties just from a compounding capital growth. Keep the 1 or 2 best properties, of course, so that at least you've got that engine, that compounding capital growth engine working behind the scenes. So I think there's a strategy there. I can't design it in my head right now. You'd have to sort of model it out, do some analysis around the properties, but really that's probably how you can make it work. There's really no other way to make it work because the income that the portfolio is going to throw off isn't going to be perfectly predictable. All you need to do is, I had one yesterday, is that you need some bathroom maintenance in one of our properties. So all you need that to happen, and all of a sudden it eats into your passive income. The second question Matt has is, we'd like to buy a retirement home in Foster for about 800,000. We hope to move there in 5 years. Should we buy the house in Foster now and rent it out while staying in our home? Alternatively, should we wait 4 years before purchasing the house in Foster until we are ready to move into that property at age 55? The key question here is, in terms of buying the retirement home, is how will your property grow relative to that property? So you kind of need to form a view on what might happen over the next 5 years. If you thought property in Foster is going to appreciate at a materially faster rate than your home, then you would consider buying today. If you think that there's no evidence that suggests that the growth gap will be wide, that they'll grow relatively similar, then I probably wouldn't buy today. And one of the reasons I wouldn't buy today is, what happens if you change your mind? I know, sometimes people come to me and say, Stuart, this is exactly what we want to do, 100%, we're set in stone, and then 2 or 3 years later they go, oh no, we've changed our mind. So, that's the thing with making home choices far out. You'd only do that in terms of in the distance. In the future, you'd only do that if you have a very, very high level of confidence, but it's really about the growth gap. Alternatively, you might go, well, our home, I think, is going to grow at a faster rate percentage-wise than what Foster will do. In that case, then you definitely don't want to buy, because what's the point? You're buying an asset and you're giving rise to greater debt, and you're not going to be any better off. So it's really the growth gap that you really need to think about, Matt. That's the main consideration. The only other consideration is depth of market. So, sometimes people go, I want to go and buy a property here. But if you're buying in a tightly held area, the right property might not come up, might only come up every sort of 3 or 4 years. So that's the other thing you need to really think about is when you're making those sorts of moves is either have a little bit of flexibility on the side. So if we move between 55 and 60, we're happy with that. Or alternatively, if you really want to be there by 55 and it's tightly held, then you might have to buy sooner rather than later. But that's the only sort of consideration there. Okay, next question is from Rob, and it's a long one, so I'm going to leave that to next time, considering I'm 30 minutes in. We're going to do, Campbell and I are planning to do a YouTube live event, and we're going to pick a few questions that we've got to talk about there. So I know we're sort of running behind. I'm still answering questions from the end of October 25. Hopefully I'll get through them relatively quickly, but that's kind of our plan. There's plenty of great questions and great content. Tomorrow, I'm going to talk about ethical investing. I have been asked before on the podcast, what do I think about ethical options, within industry super funds, for instance? And I want to answer the question from a investment perspective, not necessarily from a moral, ethical perspective, because it's really what are the investment fundamentals around ethical investing. So I'm going to talk about that tomorrow. And so until then, bye for now. Now, before you go, one last thing. My new book is called Wealth by Design. It's not a reprint of Investopoly. It's a complete and absolute rewrite based on what I've refined over the last 8 years. If you'd like to be notified the day pre-orders open and receive my pre-order bonus, register your email right now at investopoly.com.au/book. The bonus is a Investopoly research assistant. That's an AI tool that's trained on more than 500 of my blogs that I've written over the past decade. So you can ask it a question and it will take you to the most relevant ideas and framework. And I'll keep feeding it all my future blogs too, so it'll become a tool you can use ongoing. Again, register at investopoly.com.au/book. Thanks for listening. I appreciate your time.